Maybe you were just planning to include American stocks in your portfolio when you heard about Bill Ackman's $400 million loss after being a Netflix investor for just 3 months. Should you take this as a red flag and pull out of your plan? Or go ahead no matter what? In this video, we help you decide on this with a clear head. Most beginners with stock investing, whether in India or the US, gravitate towards the big names. In the US, this is famously the FANG group, which we covered in a previous video. While these shares have made incredible gains over the long term, they've each suffered phases of volatility and losses. This means you'll have to stay well informed when investing in them, judging volatile phases to see if they're temporary blips or long-term problems with the fundamentals. Case in point, the recent Netflix debacle. Long story short, when Netflix admitted to a drop in its subscriber uptake for the first time in 10 years, which was expected to continue, its share price dropped by 40% at a stretch, marking a loss of $150 billion within a single week. This is especially bad for a company that does not pay a dividend, where shareholders look forward to share price growth for any revenue. It also does not help that the platform bleeds a lot of cash flow in attempting to produce their own movies and shows, but with no considerable return on investment on them so far. Meanwhile, Netflix has offered a virtual shrug in explanation, citing factors like too many connected TVs, too much password sharing, too much competition, and finally even world events at large as causes for their situation. In doing so, Netflix may be holding themselves back from recognizing internal flaws in their model, which is essential for any company vying to get past such phases of adversity. For instance, Netflix fails to recognize consumers' demand for open and flexible platforms as opposed to closed proprietary systems. This is exactly what the CEO of Warner Bros. Pointed to as the reason behind the failure of CNN+, their standalone streaming platform, which had to shut down within a month of its launch. The best way to survive is to put the customer needs at the heart of your business model and evolve to deliver the best proposition rather than ignore customer choice in favor of rigidly held principles. Thus, Netflix's desire to operate in its own fortress without the support of legacy studios might be holding it down rather than setting it apart from the competition. So what should you do as an investor looking to enrich your portfolio with stocks of an American streaming giant? The prudent course of action is to do due diligence, get into the fundamentals, and develop an understanding of the business model before actively putting money into it. So who would be a good choice? Well, now that we have given you the tools, that's your call to make.